approach and the change in the economic useful life with one example. A machinery or any asset which is previously depreciated over 20 years, now going to be depreciated over 15 years because the Schedule 2 prescribes a lesser economic useful life. So assuming that the balanced economic useful life for this asset as on the reporting date when the Companies Act 2013 has been notified is 5 years in category A and 0 in category B. See the funny situation. The WDV is 100 because it says that you have to align the economic useful life according to Schedule 2. It's a change in estimate. Because it's a change in estimate, I will do an prospective adjustment. That means whatever is my WDV, I have to depreciate over the remaining economic useful life, which is 5 years, which will go to my P&L account. Every year 20 rupees will go to my P&L account as a charge. I don't have a problem. Only thing is my depreciation charge might have been accelerated where you have used Schedule 14 rates for your purposes. There is a second situation where the balanced economic life is 0. That means 15 years is already over. But WDV is carried over under the existing schedule is 100. The entire 100 has to be charged not to the profit and loss account but to the reserves and surplus as an adjustment, as a transitional provision. I take one example to see how funny is this provision. Instead of I am saying that the balanced economic useful life is 0, if I am saying only 1 day is left out, the charge will go to P&L account. This 100 will go to P&L account. If I am saying 0 days, it will go to my reserves and surplus. That is the way in which the rule has been drafted for this. What would be the implication of this? Just have a comparative analysis of the revised the Schedule 2. Continuous plus processing equipment, previously it was 19 years, now comes to 8 years. What is the basis in which they have identified that economic useful life is only for 8 years, where I have seen a lot of continuous processing industries are still continue to use the machinery even after 19 years. So the problem is I have to apply the transitional provision for the existing assets which is sitting in my financial statement and see whether 8 years is already over. If 8 years is already over, entire thing has to go to my reserves and surplus. Because it goes to reserves and surplus, I will have a lot of issues. Whether the company should always follow SLM, there is no clarity on this because they are not prescribed any method. You can either use SLM or you can use WDV or you can use some other method which will be economic pattern in which the returns are coming to the entity because accounting standard says that. But only one caution is when you are charging a depreciation, please also make a cross check that the depreciation charge is not lower than if you are applying the economic useful life on straight line basis under Schedule 2. Please ensure that at least you are having that. If you are charging higher depreciation on WDV method, it's not a problem. But if you are charging a lower depreciation, please cross check that you may be asked to explain by the MCA. It's a change in accounting estimate, so I will not waste my time. So it will be prospective, it will not be retrospective. Is there any ceiling to fix a residual value? First time the Act has defined the residual value is 5%. So you have to necessarily have 5% as the residual value, only the balance has to be amortized. Residual value cannot be more than 5%. That's a word which they have used it. I have literally certain cases where the companies have come out with an possibility where they have said that if I am buying even a second-hand equipment, I have a resale value because of the market conditions higher than 5% of this. But for those also they have not given any exemption. They have said that it cannot be more than 5%. If the asset is put to use for lower than its economic useful life, what is the period in which depreciation has to be calculated? For example, 8 years is the economic useful life for a continuous process machinery, but the management at the time of acquisition has decided to use this only for 5 years and I will replace it with a new machinery on the 6th year. Then you cannot say that my economic useful life in schedule 2 is 8 years. You have to have the economic useful life as per the accounting standard, which is going to define this economic useful life, is 5 years. In that scenario, you can have a higher residual value, because residual value is at the end of the economic useful life. Here you are deciding to automatically replace this asset based on internal decision. I believe that you can have a higher residual value in that situation. Extra shift depreciation, that is also prescribed. Double shift means it will increase by 50%. Triple shift means it will increase by 100%. Whether it will have an impact on managerial remuneration, definitely, because the transitional adjustment will bring down the effective capital. So whatever you are applying under schedule 13 for the minimum remuneration will also have an implications with all other sections. For example, section 186, which is not yet notified, but 372A, which is talking about the limit with which the investment can be made, is also based on the net worth. So that will also have an implications. Even with the investment which you have already made will now become, you are exceeding the limit. That could be a possibility. Necessary. If it is not specifically given, the management can estimate the economic useful life and they can apply that principles. Corporate social responsibility, you know that it's 2% of the average profits before tax for the last 3 years. Directors report shall disclose reasons for not spending the amount. This is what I am thinking, that whether still corporate social responsibility is mandatory or it is only optional. It only says that you spend this money. If you are not spending, there is no penal provision. None of the Companies Act section is having a penal provision. It only says that you have to disclose what is the reason for which you are not able to spend this money. So in my view, if the company is able to demonstrate what is the rationale behind not spending this money, still they are within the law. But of course, only thing is, it is an accumulation. Unpaid money should be carried over to the next year along with 2% of the profits of the next year. So, and it should be used for only CSR activity, but it cannot be used for any other purposes. Some of the points which may have an implications on my accounting perspective is the composition of the board of directors for the directors level. Every company, if they are falling within the ambit of CSR, should have a CSR committee, and the CSR committee should have 3 directors. One should be an independent director. Suppose if I am talking about a private limited company which is not required to have an independent director, but it has a CSR requirement, that company should also have an independent director. That is another issue which will come in. Simply, if I am giving a donation or carrying out a charitable activity, that is not considered as CSR activity. CSR activity has been defined in Schedule 7. That is what you are supposed to use it. Okay. Other provisions, books of accounts maintenance, recast or reopening of the accounts, and filing of revised financial statement, all those things is coming new. What is prescribed into the in other countries is also coming in. So if there is any specific question, I will take along with the chairman. Before I wind up, I just wanted to share this video.
No reason to be unfair. Netcom, same price for everyone.
Only one caution with this video is that we may try to have a balanced approach by means of doing some practical adjustments here and there, but try to make that practical adjustments only within the ambit of law, because there is the chapter which I have not dealt with on the punishments and the penal provisions for want of time will make you to realize whether I have to still have a corporate structure for my company. So try to be a little cautious on that. Thank you very much for the excellent opportunity. For the question and answer session, I will take the help of the chairman also. Thank you.
In case all of you raise the question, because we'll spend more time in terms of giving clarification for the doubts that we may raise. Please go ahead with that.
This depreciation useful life regime, which financial year will it be applicable?
Okay. See, because this section is not yet notified, or the schedule is not yet notified, only when the entire thing has been notified, we will be able to apply the principles of the revised schedule 2. Up to that period, you can still go on having your schedule 14 rates. Only thing which I will suggest is, please do a small homework of when the act is notified, what would be the implications of the depreciation amount or the WDV of your carrying cost will go to your reserves and surplus, and how much will go to your P&L account. I have not touched upon one point on what would be the implication on MAT. Suppose everything goes to my reserves and surplus and not getting adjusted in my profit and loss account, then the MAT liability will go up, because the book profits which you will be showing will be higher if you have planned in a different manner to avoid the book profits. So you have to make some homework on the depreciation impact, both on what are all the sections or what are all the provisions which I will have an implication directly related to net worth, and net worth will get eroded by means of the transitional provision, and the accelerated depreciation for the balance economic useful life, how much will come as a depreciation charge and what could be the tax related issues on that. So this, I think that it has to be done, including the assessment for the component cost approach for the existing machinery.
Now I have a continuation of the same question.
Yeah, please, sir.
Now when we say rate regime, we understand from the standards that we can follow either straight line or WDV. The option is given to the company. Now when it is a useful life, we say, for example, the remaining useful life is 6 years. The WDV is divided by 6. That is equal to depreciation. That means the method of depreciation by default, is it straight line, or can I go back to my depreciation accounting class and learn another formula where I can invent the WDV rate using this mechanism? Can you elucidate on this?
As I have shown in my one of my slides, the Act has not specifically mentioned what method you have to use, whether it's a straight line method or a WDV method. It has not prescribed anything. So naturally, the general principles of depreciation will apply. Accordingly, I will be eligible to have WDV method also. That is the reason why a word of caution which I have given. When you are applying the principles of WDV, your economic useful life adjustment cannot go beyond what is prescribed in that section. So what will happen? If I am saying 6 years is my economic useful life, under WDV method, your charge in the first year will be higher in a different perspective. So, as you are rightly pointing out, you have to work out a derived percentage to charge. It is not flat rate of, for example, if I am talking about continuous processing machinery of 8 years, I cannot divide by 8 and then charge, but I have to arrive at in a different rate, which will be much higher than that proportion.
Now, going back to that schedule, the useful life schedule of the New Companies Act 2013, the first few lines they say the useful life is applicable for the both type of assets, that is tangible and intangible assets. But when we go into the line item, the useful life is only prescribed for tangible assets.
Correct.
Is it yet to be, or the schedule will be amended?
I believe that it's a drafting issue. They have not specifically taken an intangible asset in Schedule 2. It must be a drafting issue. But having said that, that is the reason why I have taken one more practical way of handling this. Suppose if nothing has been prescribed, whether I have to go to central government to get the approval for what is the rate? No. Management can decide what is the rate. So for an intangible asset, if the management decides that my intangible assets will still continue to have 10 years, because the accounting standard says that the presumptive assumption is 10 years, you can continue to have 10 years.
So AS 26 will fall.
I have one clarification,
Yes,
sir. Especially for retail industry, now most of the stores will be operated through primary leasing. Now, with respect to the earlier years versus now current year, there is a rapid change, I think. It will be a severely and significantly affecting with respect to the depreciation. Now, it's recently specified that 3 years is the life period. Now, by that time, what is to be done with respect to the current financial year in depreciation accounting?
Yeah. See, I will take this question in two parts. Sir, you can please sit. I will